morning. Let's talk about the earnings first, because recessionary concerns have clearly been plaguing international trade. Your top line has also been declining now for the third consecutive quarter, as I understand it. How concerned are you, since a major chunk of your revenues does come from the international supply chain business?
So thanks. It's a pleasure to be on your show. And let me reiterate that in our business, ocean freight rates are a pass-through cost, and therefore any downward trend does not really impact the business performance. It, yes, of course, does bring down the revenue, as you have rightly pointed out, but it does not impact the margin, which continues to grow and remain sustainable. What we have seen in the last quarter was clearly a quarter filled with macroeconomic headwinds. There was a pressure on consumption, people going down on inventories, the global trade went down. So it is quite satisfying for us to have maintained the volumes and demonstrated the resilience that we have built in our business over the last couple of years. So if you look at the performance against this macroeconomic environment, we have reported the highest ever EBITDA margins for the business. And this comes from the fact that while the macroeconomic headwinds were there, we continue to grow by expanding market share in some of these difficult countries. Taking some examples, in Asia, Vietnam, which has emerged as an alternative to China, the port volumes dipped by 30%, but we were able to hold on to our volumes largely. UK market witnessed a drop of almost 25% in the LCL business, but again, we performed well. In the US market, we increased our exports shipments in a situation wherein the competition went down by 15%. So yes, there are economic headwinds, and there's a little bit of sluggishness in the trade. I'm sure people are aware that in the last quarter gone by, the global ocean trade went down by 3%. But what we have done by leveraging the world's largest and the most efficient LCL network, which we have built and we own and operate, and now over the last couple of years, we have built out the digital platform on top of that. So the kind of unique positioning it gives us in the market, the kind of client servicing we're able to do, all of this puts us into a huge competitive advantage. And that has been demonstrated in this quarter's performance, if you really look at, in terms of how we have not just held on to, but went on to improve our business EBITDA significantly over the last year, despite all these macroeconomic headwinds. That's how I would like to describe our performance. I would say it's been a tremendous performance in a very difficult environment.
Fair point. But digitization as a theme has been gaining traction. You deal with digital-focused approach now. You have about 60% of your export shipments booked digitally. Has this aided the market share gain and the customer addition as well? And is this going to be a key driver going forward as well?
Yes, absolutely. With the digital interfaces providing a deeper hook into the customers, the engagements become much more seamless. The customers are able to get superior service. By integrating our ERPs with theirs, they are able to get better visibility and better control over the shipments as well. Talk about an example situation wherein a shipper is looking at a quotation in such a volatile environment. It could take sometimes up to 2 days for the shippers to get a quotation. While logging into our EQ360 system, they could get a door-to-door quote in almost all the key countries, about more than 50 of them, in a matter of seconds. So these capabilities that we have built clearly put us at a competitive advantage. If I was to describe in a slightly different way, I would say that each industry has a market leader and each industry has a disruptor, a tech challenger. Fortunately for us, in the global LCL industry, we are also the world market leader and we are also the tech disruptor ourselves, wherein we have been disrupting the industry trends by pushing for digitization and deeper integration with the customers. And that's really come in handy in creating this resilience in our performance, which you see in this quarter.
Just wanted to get in a sense as to what has been the performance or the updates on the recent acquisitions. Nordicon, given the fact that, we saw the war in Ukraine, has that impacted business? And what about Gati with the additional 30% stake? Has competitive intensity impacted performance?
Yeah, so on the Nordicon, despite all the Ukrainian situation, the rail business going down, the performance has more than doubled since our acquisition. So therefore, that continues to remain strong. Our market leadership in all the 4 Scandinavian countries continues. Closer home on Gati, we have had an exceptional turnaround over the last couple of years, and the company is very well positioned to take benefit of India's economic growth. And that is the reason why the vote of confidence on the business and the management team, Allcargo, has decided to further increase the investment buying out the partners KWL completely in the operating business entity. On the performance, if you notice, in the first half of FY23, Gati has already done more business EBITDA than it did in the entire FY22. The company is clearly on a strong growth path, and we believe in the tremendous potential it holds.
Fair enough. That's the latest when it comes to the overall acquisitions. What about the demerger? Because I understand that the company's restructuring was announced last year. Any updates on the demerger front, when it could happen? What could be the potential value unlocking for shareholders?
Yeah, so I'm glad to share that the demerger process has been going well. In fact, marginally ahead of schedule. We had indicated that it would be complete by April, May. Now we don't see it going into May, and in fact, it might conclude by March itself. By way of demerger, the real estate business would go out into the demerged Trans-India Realty. The CFS ICD business would get demerged into Allcargo Terminals, and the remaining express contract logistics and the largest international supply chain business would continue to be part of Allcargo Logistics. In terms of the value creation for shareholders, it would be an outcome of the strategic independence that the businesses gain, and thereby the growth opportunities that unfold for them. The real estate business would be able to benchmark itself against the large asset-based businesses, which are backed by sovereign funds and private equity in India and globally. The terminal business would be able to play out to its potential. And talking about the asset-light business, if you notice, the international supply chain business, which contributes to nearly 80% of our business, actually has an astounding ROC of 60% in this quarter. So with that kind of return on capital employed, with continued leverage on technology, and with our ability to do bolt-on acquisitions, this company is clearly poised for continued growth. So the demerger would facilitate all of this. It will bring in the sharper focus, and it'll allow all the businesses to grow in a much more holistic way. And like I said on the timelines, it should mostly get done by March.
Great chatting with you today, and thanks for so candidly helping us understand what's going on with the company, not just in the quarter gone by, but moving forward as well. That's pretty much all the time we have on this edition of Closing Trade.